Welcome to the Deep Dive, your shortcut to understanding the biggest moves shaping the market. Today, we're plunging deep into a really colossal moment in the consumer packaged goods world. We're talking about the Kraft Heinz company, or KHC. They've just announced a tectonic shift in leadership and a pretty drastic corporate overhaul.
Yeah, they're planning to split the entire business into two separate publicly traded companies. I mean, this isn't just a minor tweak. It feels like a calculated, maybe even a desperate gamble to reverse years of stagnation. So our goal here is to really break this down. We're going to unpack the timing of the CEO change, the specific rationale for this dramatic split, and what it all means for KHC's balance sheet and its future.
Let's start with the immediate news, the leadership piece. Steve Cahillane is stepping in as the new CEO of Kraft Heinz, and that's effective January 1st, 2026. And this change, it really speaks volumes. The current CEO, Carlos Abrams-Rivera, he's stepping down, but will stick around as an advisor until March to, try to ensure a smooth transition.
Which they'll definitely need. Oh, absolutely. Given the complexity here, it's essential.
And this isn't just about a new face in the corner office. This is really the prelude to a corporate divorce, right?
That's the perfect way to put it. They've confirmed the plan to divide into two independent companies. The whole thing should be finalized in the back half of 2026.
And it's structured as a tax-free spinoff for shareholders, which is a key detail.
A very key detail. But what's really revealing is Cahillane's immediate mandate. He's specifically slated to lead just one of the new entities, the Global Taste Elevation Co.
So he's not even running the whole thing post-split. He's taken the growth piece.
Exactly. And John T. Cahill, he's moving to board chair and will keep overseeing the separation committee. This whole structure, it's a clear signal of where they believe the real value is.
Okay, let's unpack this. A split of this magnitude is not cheap. It's not easy. Why is a company as, iconic as Kraft Heinz resorting to such dramatic surgery right now?
Well, the answer is really in their history. You just have to look at the numbers and the market reality. The company's compounded annual return over the last 5 years was -2%.
Wait, negative. So you actually lost money just by holding the stock.
You lost money. While the broader CPG index was up, 7 to 8% over that same period?
And the S&P 500.
The S&P was up 15% annually. So KHC hasn't just trailed the market, it's been completely routed. The stock is down something like 75% from its peak back in 2017.
Wow. That suggests the problem is much deeper than just a few bad quarters. Was the original conglomerate structure from the 2015 merger just fundamentally flawed?
I think it's a bit of both flawed structure and flawed strategy. But the structure definitely made the strategic flaws worse. The foundational problem, and you see this in all the analysis, is just chronic stagnation.
Especially in North America, right?
Especially in North America. They've struggled with what management itself calls operational complexity. The company is just too big, too diverse, from Lunchables to ketchup to cream cheese to manage costs and move quickly.
And all of this is happening while the entire industry is shifting under their feet.
Precisely. You have to overlay that internal struggle with these huge structural headwinds. Consumer priorities are just fundamentally different now.
Okay, what are the big ones?
Well, there are three major shifts. First, this massive move toward healthier, less processed food. Consumers want clean labels, they want protein, they want fiber.
And KHC's portfolio is kind of the opposite of that in many ways.
It is. Second, you have economic pressures pushing people toward private label brands. Affordability is king, especially in the grocery aisle.
And the third shift is the rise of the small players, right? The startups.
Exactly. These nimble little startup brands are just eating away at their market share. So this split, it's a defensive move against all of that, but it's also an aggressive bid to unlock value by forcing some real strategic focus.
So let's talk about that focus. The whole point is to create two companies optimized for two very different environments. How do these two new companies actually shape up?
So you're essentially splitting the firm into a high-growth, premium margin business and a stable legacy staples business. The first one, the one Cahillane will lead, is the Global Taste Elevation Co., or GTek.
Okay, so what's in GTek?
This is the powerhouse brands with global appeal. Think Heinz ketchup, Philadelphia cream cheese, Kraft mac and cheese, HP sauce. It's positioned for global growth, and they're targeting about $15.4 billion in net sales for 2024.
The other half. The less glamorous, but still massive part.
That would be the North American Grocery Co., or NAGC. This is the one that's all about staples and heritage brands that really dominate U.S. grocery aisles: Oscar Mayer, Lunchables, Kraft singles.
And its sales target.
Around $10.4 billion for 2024. But, the chatter among analysts is that this division is really about managing legacy brands. Some have even bluntly called it the leave it behind portfolio.
Leave it behind. Wow, that's a potent phrase for investors.
Right.
So what does that mean, running a company focused on managing decline versus one focused on growth?
It changes everything. I mean, capital allocation, marketing, the kind of talent you hire. GTek gets the green light to invest heavily in international expansion. NAGC, on the other hand, it has to become ruthlessly efficient, just focused on cost management to keep its margins.
So it's an operational challenge, not a growth one.
It's exactly.
Yeah.
And that makes the choice of Cahillane to run GTek absolutely critical. He didn't come from inside KHC, but he has very direct, very recent experience with this exact kind of thing.
Right. He guided Kellogg through its big separation.
He did. The split that created Kellanova and WK Kellogg Co-Coast, Cahillane's basically paying for that proven skill set. His stated focus is already clear: organic growth, leaning it to health and wellness, and modernizing these brands without, alienating their core customers.
This brings us to a really fascinating point about leadership. It's not just that he did a split, it's about his whole career trajectory.
What's fascinating here is this concept of the breadth premium. There's academic research that shows a clear correlation between a CEO's career experience and corporate success after a big restructuring.
So because Cahillane's resume spans different companies like Coca-Cola and AB InBev, not just one narrow field, he's seen more.
Precisely. He's not just a specialist who spent 30 years mastering, canned soup. He's seen how huge global organizations operate. For example, his time at AB InBev dealing with global logistics and a portfolio of premium and value brands that's directly applicable to growing Heinz ketchup globally.
And the data actually backs this up.
It does. The research shows that firms led by executives with that kind of broad experience have historically outperformed their industry benchmarks by nearly 10 percentage points over a 3-year window after they're appointed.
So KXC is basically betting that his wide-ranging history gives him the adaptive capital needed for this messy transition.
That's the bet. They need an integrator, a connector who can speak the language of manufacturing, global marketing, and corporate finance all at once.
That makes perfect sense. But leadership is only half the story. Let's look under the hood at the financials, because a great strategy doesn't mean much without a stable balance sheet. What kind of shape is KHC in right now?
The signals are acutely mixed, and frankly, they lean toward risky. We have to start with the Altman Z score, which measures corporate distress. KHC's score is alarmingly low at 0.44.
Okay, for listeners who don't track solvency mechanisms, why is 0.44 a red flag?
Well, the Altman Z score is designed to predict bankruptcy risk. A score above 3.0 is considered safe. A score below 1.8 is the distress zone. At 0.44, KHC is deep in that distress zone.
So there's a material risk if things don't turn around quickly.
A material risk, yes. On top of that, the balance sheet is carrying a huge amount of goodwill and intangible assets, about $60 billion relative to its equity of $41 billion.
Which is a legacy of the big premiums paid during the merger.
Exactly. And it makes the company structurally vulnerable to massive write-downs or impairment charges.
And we've already seen that risk materialize, haven't we?
We have. We saw it with that staggering $9.3 billion impairment charge in the second quarter of 2025. That charge alone highlights that the value of those brands on the books might not be supported by their actual cash flow.
So despite all those flashing red lights, some people in the market see potential value here. How do we square that risk with the valuation?
That's where the story gets complicated. The core valuation metrics, they're near historical lows. The price-to-sales ratio is 1.16, price-to-book is at 0.7. So these numbers suggest it could be undervalued if, and it's a huge if, this whole thing works.
And there's a dividend, too.
Right. The stock has a 6.5% dividend yield. That attracts a lot of income-focused investors who might overlook some of the operational risk as long as that dividend check keeps coming.
So analyst consensus is what, a hold?
It's a hold with a target price around $27.55, but you see fair value estimates all over the place, from $22 up to $68. It just shows how divided everyone is.
The ultimate risk, then, isn't just the current financial health, but the execution of the split itself. What happens if this surgery goes wrong?
Absolutely. The central risk is that the separation actually magnifies all the existing problems. It could lead to what are called dyssynergies.
Hang on, dyssynergies, what does that actually look like for them?
Well, synergy is when two companies merge and save money by sharing, an HR department or an IT system. Dyssynergy is the exact reverse. When you split, you have to create two of everything.
So 2 HR departments, 2 legal teams, 2 payroll systems.
Right. And all of that duplication means the two new companies actually have higher standalone operating costs. If they don't execute this perfectly, those costs could erode their margins faster than the new focus improves their revenue. So if we connect this all back to the bigger picture, the thesis about leadership and value, we can actually build a plausible trade idea out of it.
Okay.
The core idea is to bet on that breadth premium, on the superior leadership and the clarity of GTek, but you have to hedge against the execution risk in the slow-moving NAGC.
So what's the trade specifically?
The outrageous but plausible trade idea is this. You take a long position in the global Taste Elevation Co. when it spins off, and you pair that with a short position in a basket of its North American CPG laggard peers.
So you're buying the focused growth entity with the proven leader, and you're shorting the slow growth category that the other half, NAGC, is stuck competing in.
That's the play. It's a bet that the market will immediately give GTek a premium growth multiple because of its brands, its global exposure, and Cahillane's reputation. At the same time, you're betting against the peer group that faces all the same structural problems as NAGC. It's basically an arbitrage on strategic execution.
A very clear thesis. And it really rests heavily on Cahillane's track record right at that moment of separation. So to recap, this strategic split is KHC's big attempt to create 2 focused, agile companies. And everything hinges on leadership execution. GTek has to accelerate growth, and NAGC just has to stabilize its legacy brands. This whole situation is just a critical case study in how these old CPG giants are trying to adapt. It really shows us that sheer scale isn't an advantage anymore if it just creates complexity. But here's the final provocative thought for you to consider. The North American grocery company, which has the toughest job here, still needs a permanent CEO. Will the board hire a specialist, someone who just knows North American efficiency inside and out? Or will they double down on the breadth premium and hire another adaptive, broad-based leader to manage the slow decline of these heritage assets? That choice is going to tell us everything about their true long-term priority.